Hello dear friends. In this video, I would like to touch upon the subject that forms the basis of many different strategies I have shared with you so far. What is this topic? As I mentioned before, we stated that when we analyze the chart while trading on all stock exchanges, the price definitely shows some reactions in the consolidation zones. The action we call smart money inflow-outflow takes place in the consolidation zones, and the big market makers place orders in these zones and give the market a trend direction. In this video, we will learn how a clear trend in the market reverses and how to detect this in the safest way. Let's start. First, let's learn how the trend is formed on a template, how the trend will turn with the valid breakout movement, and how this reversal signal will be confirmed afterwards. We see a falling trend on the screen. We draw a trend line by touching the upper levels of the candlesticks that form this falling trend. Subsequently, the trend line is clearly passed upwards with a voluminous green candlestick. Of course, it should not be concluded that the falling trend has definitely ended with this breakout movement, because such reversals can often be trap moves applied by large capital market makers. We will need an additional confirmation to be sure the trend reversal. Now we see an emerging formation, but for us to be sure that this trend will be a real uptrend, it is necessary to close above the resistance line I drew. The upward crossing of this resistance line confirms for us that buying pressure is now increasing in the market. Of course, it is important to use Fibonacci ratios to know how this reversal will continue. After reviewing the schema, let's now work with an example from the 15-minute time frame of the Australian dollar-Swiss franc parity that has occurred on the chart. We see a very clear falling trend on the chart, and let's see where this trend will end, and at what level we need to enter the market as the market reverses direction. Pay attention to the wave movements as the price continues to move down. All major lower levels are falling below the previous level, and as this action continues, the seller group is constantly making profits in the market. Of course, this action will also have an end. Yes, here we see a voluminous green candle passing through the falling trend line strongly. As always, we expect a retracement movement behind this breakout movement, taking into account the possibility of this movement being a trap. I would like to remind you that it is a very wrong attempt to open a trade without waiting for the candle that passes the trend line to close, and usually traders who are new to the market often make this mistake. I would like to state that I have seen hundreds of times that the candle that makes the breakout movement leaves a large wick on the trend and closes its body again below the trend line. Patience and discipline will bring success. After the aggressive intervention of the buyer group in the market, a slight retracement movement occurred. Pay attention to how small the body of the red candlestick that the retracement movement occurred with, because when a very strong counter move comes to the long-term falling trend, the seller group becomes hesitant against this move of the buyers. We know all these struggles, but we combine the right analysis and patience to be able to take our profit. Now, the upward break of the intermediate resistance line we drew will convince us that the buying pressure in the market is increasing. Here you see another voluminous green candlestick that passed the resistance line. Now, a long position can be opened. And let's pay attention to the development after the trade is opened, because an interesting market action is forming. From where we entered, the price is rising in line with our expectations. Then it loses momentum again and falls below the intermediate resistance line we drew. In fact, very shortly after falling below the resistance line, it tests the line we drew point blank. So, we can understand that we drew our resistance line from a very accurate level. The resistance line prevents the price from going up again. The tug of war between the two groups seems to be in a horizontal trend in the market, and the price is stuck in this region. After a while, the price rises above the line we drew again and rises a little more, and the pressure in the market increases in the buying direction. As you can see, how well the line we drew before works both as support and resistance. Nevertheless, the level you draw as a support or resistance line completely loses its validity after it is passed up and down several times and should not be taken into account. After rising 34 pips, the price breaks down the level that is working as a support line again, and as you can see, it cannot be passed up by the buyers after being tested 3 times in a very clear way, and the seller group that won this tug of war sends the price down rapidly. Analyzing the market in this way always increases the success rate of the transactions you are considering entering. It is very important to analyze in this way whether you trade by examining the chart from a 3-minute time interval or a 1-week time interval. Before entering a transaction, be sure to look at the chart from a wide frame by zooming out. This will make it much easier to understand the direction in which the market is under pressure and will give you a preliminary idea for the transaction you will enter. See you in our next video. Don't forget to subscribe and like the videos. Bye.